All right, my friends, so I'm going to talk about what a dividend yield is and a yield on bonds as well. I've done this a couple times before, but I think it's important for you to understand how a dividend yield, what it reflects, all right? So it's easy to get caught up in the yield of a dividend or even the interest rate of a bond, not the interest rate, but the yield, current yield of a bond. Always remember, the important thing is not the yield. The important thing is actually what the coupon is on a bond or the actual dividend per share of a stock. That is the most important thing. A coupon on a bond, if a bond is paying, the coupon's 5%, all right? So it pays $5,000 a year for a par bond. So a bond is issued at, we'll just say $100,000 for simplicity. It pays $5,000 a year. That's 5% of the coupon. If the price of the bond drops to $50,000 from $100,000, what is the current yield at that point? Well, in that case, the current yield is 10%, because the price has gone down in half. You're still getting the $5,000 annual coupon payment, but it's being paid out on a lower, much lower in this case, price per share at $50,000. That makes sense? So it's issued at $100,000. That's the par, the issue amount. It has a coupon rate of 5%. That means it pays $5,000 a year in cash to the bondholder. The bondholder gets $5,000 a year until one of two things happens, or three things really. The bond matures, the company, the issuer goes bankrupt, or if it's a callable bond, I'm not going to get that, but they call it away from you. And so in this case, that's the only thing that will happen between you and your $5,000 a year of interest. But people get suckered into current yield. Oh, the current yield is 12%, 16%, 10%. The only reason the current yield is that high is because the price per share has gone down. And a bond doesn't really have a price per share, but just assume we're talking the same regard. The bond, again, the price, the value of the bond, we can say that for liquidation has dropped quite a bit. That's the only reason the coupon or the current yield would be that much higher, is simply because the price has gone down. And then you got to say, why has the price gone down? What is the information out there that everybody else has that says this bond has a reason for it to decline by 50% in value, even though it's still paying $5,000 a year? Same thing happens on a dividend. A stock trading at $100 a share has a $1 dividend. All right, so that's a 1% dividend yield. All right, now that stock goes down to $50 a share. It still has that $1 dividend yield, but the dividend is $1 per share. The stock is at $100. The dividend is $1 per share. The dividend yield is 1%. The price of the stock drops to 50. It still has that $1 per share dividend yield. It's $1 per share dividend. The dividend yield now is 2%. It's doubled. It's gone up from 1% to 2%. And the only reason that's happened isn't because the stock did anything with their dividend per share. It's just because the price per share dropped like a brick in water. And there's a reason for that to happen. I mean, one of the reasons GE, their stock drops so much is simply because they're going to cut their dividend, and people buy GE as a blue chip in order to get a big fat dividend. Well, once that big fat dividend goes to the wayside, people say, I don't like this anymore. So understand why a stock has a high dividend and why a bond has a high yield, a current yield. You got to understand that before you buy it. Don't just buy it because the dividend looks so attractive. It might well be. Maybe it's a buying opportunity. I think GE this year's up 30%. I don't know, but I mean, 30% off of $6 when it used to be the bluest of blue chip. That's not very impressive. That could easily be a dead cat bounce. So just understand what you're buying when you see something as a high dividend or a high coupon. What you really want to do for a corporate bond, I think the average yield probably right now is about 4%. So if a corporate bond is paying more than 4%, there's a reason for that. It's riskier. No other way around that. It's riskier, and the price has gone down on current bonds. There's just no two ways around it. If the average corporate bond has a 4% yield and you're getting 6% on your corporate bond, it's riskier. There's just no two ways around that. Same thing with dividend. If the average dividend on the S&P 500 right now is about 2.5% as the yield, and your stock is paying 5%, why? Why is it doing that? And look, I'm not saying avoid it. I'm just saying know why it's doing that. Don't just buy it because it has a high dividend or high current yield. That's fool's gold. Unless you research. If you research, it's fine. But it's fool's gold to say I'm buying this with a higher dividend, higher current yield, and thinking all is good, because it might not be. All right, as always, 4 S's. Subscribe, share, smash the like button, and say your comments down below. Thanks, guys.